How to finance buy-to-let and investment property. That's what this video is about. I'm joined by my special guest, Akhil Mair, our mortgage broker. Thanks for joining me.
Thank you for having me.
Now, we put out a request on social media to all you guys, and we asked for all your property finance related questions. You inundated us with a whole bunch of questions, and I've got them all here, and we're going to discuss them and probe them and give you some answers. Because, you know, people talk about having a power team, and people talk about an essential person in that power team being the mortgage broker. But I think a mortgage broker is not that impressive. No offense. But to me, a mortgage broker is someone who goes through a computer and just has access to a computer system that you don't. And just matches, you know, says, oh, this lender's doing X, that lender's doing Y. For me, someone in your power team needs to give you solutions to your property funding challenges.
Yeah.
And if you don't understand that, then how can you provide those sort of solutions?
No.
Would you agree with that?
No, I totally agree. And the days of just using systems to source deals is somewhat diminishing because of criteria. No client is like the other, and no lender is like the other too. So there's so many variables that we need to take into account as a mortgage broker. So you're totally right.
And of course, the nature of property is changing, because 10 years ago, a lot of people were just doing vanilla buy-to-let, single-family type of dwellings. It was very simple assessment.
Yeah.
Now the kind of things people are doing are so varied.
Yeah, I totally agree. There's loads of quirky deals going on at the moment. We've got HMO, service accommodation, Airbnb properties, limited company transactions, in trusts using SaaS for commercial. So there's lots of quirky deals going ahead, which is good news for the market.
So we've got a whole bunch of these questions. Now, you can watch through the whole of this video. You'll learn oodles, because we're going to go through a lot of these things in quite a deep dive kind of way. Or if you look at the description below this video, you will see time-coded all the questions, and you can just fast forward to questions that take your fancy if you so desire. Do remember, if you're new to this channel, we put out new content each and every week. So make sure you subscribe and hit the bell icon, and then we'll let you know as soon as we upload, because we put out new videos each and every week, and they're all dedicated to helping you become a more successful property entrepreneur. So let's just get on with it. We're going to focus much more on investment property finance and buy-to-let type of finance. A lot of people starting out in property ask, do they have to be a homeowner before they can get into buy-to-let and buy a buy-to-let property with a buy-to-let mortgage?
Yeah, Ranjan, that's a good question. Now, I get tons of calls every day, every week into the office, and they're always asking, how can I get on the ladder? And there's myths that they need to either own their own home or have a buy-to-let in the background. And the short answer is you can buy a buy-to-let property even if you don't own your main home. So you might be living with your parents, and you might want to have got some cash built up in the background, and you want to invest in buy-to-let property. There are lenders out there that would allow you to take a buy-to-let mortgage out without being a homeowner.
Yes. I mean, I started that way. I lived with my parents. I had 5 properties, I think, before I bought a place to live in. So of course it's possible, and it's a good way of doing it, because when you're starting out, your own home that you live in, the rent you have to cover from somewhere.
Yeah.
But with buy-to-let property, the rent is covered by the the mortgage is covered by the rental income that you're making. So it's a different proposition.
Totally agree. Yeah.
So what do you have to earn?
The answer is zero. Most lenders want a minimum income, that is the truth of it, but there are lenders out there that want zero income, and they will allow you to buy a property.
So essentially, the buy-to-let lender is looking at the income of the property rather than the income of the individual behind it. But you do have to have clean credit.
Yeah, so the key thing you have to remember is you have to have clean credit, a good credit profile, and the property that you will want to buy, it needs to stack up. And what I mean by stack up is the valuer goes out and values that property.
Yes.
And assesses it. So if you're buying something for 100,000, they'll ensure that the property is valued at 100,000, and it will bring in, say, for example, £500 per month. So it's got to have the rental needs to service the mortgage itself.
Now, when I got started, loans in limited companies were very, very difficult to get. There were very few lenders doing it, but with Section 24, the landscape has changed dramatically for that. It's got a lot easier. In your view, I mean, when people come to you and you must get asked the question, should I get a personal mortgage buy-to-let or should I get it in the limited company? What advice do you offer?
Okay, so with terms of advice, it's a very tricky ground, especially with the whole tax piece around limited company space. So I would always say speak to an accountant, and not just a general accountant, a property charter tax accountant. That's key. That's the first thing that clients need to establish, whether they're going to invest via their personal name or in a limited company. Once you've established that, we then choose the right deal for you. So if you're looking to buy something through a limited company, there are now 40 odd buy-to-let lenders in the market. There's over 2,000 products in the buy-to-let space, of which there are 500 products just in the limited company space. So that gives you a good indication that lenders are growing in the limited company space. There's lots of confidence in the buy-to-let market still in the UK, and lenders want to lend, and there is a home for virtually every single buy-to-let deal in the UK.
I think really, if you are looking at doing buy-to-let in your own name, there's no real case for buying more than one or two in your own personal name anyway. So the lenders have to have limited company products.
Yeah, and I totally agree with that. Especially if you're a high rate taxpayer through your employment, it's probably keen that you go through the limited company route, just simply because you can still offset 100% of your interest via a limited company rather than through your personal name. And just to give you an indication, it's not just about the tax relief via a limited company. The amount that you can borrow through a limited company is a lot more generous through a limited company feed rather than personal. So lenders will assess the amount of lending they can lend on a property more on a limited company basis. Simple reason is because of the ICR that they choose to use. Two benefits of borrowing through a limited company. One is the ICR is calculated at 125% rate, which allows you to borrow more monies.
Yeah.
If you were to buy a property in your personal name, it's calculated based on your tax threshold. So whether you're a basic or a basic rate taxpayer, higher or even higher. So that's calculated there, and then you get a lower borrowing levels for your buy-to-let mortgages. Now, there's two ways that lenders calculate it. One is through the ICR, which is the interest cover ratio, and then they times it by the rate of interest. So there is a notional rate of 5.5, depending on what lender you go to. Or if you choose to go for a 5-year deal, most lenders will allow to calculate the loan based on the pay rate at the 5-year. So say for example, a lender X is offering you a loan for 5 years at 3.49, so you'll do the ICR rate at the 5-year pay rate, which is a lot more keener with terms of borrowing, so it does give you an enhanced level of borrowing.
That's a lovely little loophole, because there is something buried in all the banking lending guidance somewhere along the line, that because the fixed rate term is 5 years, it's deemed a long enough term that you shouldn't have to plan for rising interest rates.
Right.
So that's why they don't have to stress test for that element of it, which is a huge advantage. I guess you must have seen in recent years a growth in 5-year fixed term borrowing in limited companies.
Oh, 100%. And there's more and more 5-year deals coming into the market. And actually, a lot of lenders are now reducing their 5-year term rates as well. So the difference between a 2-year and a 5-year is somewhat being squeezed, which is a good thing for the client.
Yes, because the costs of remortgaging now are going up, aren't they? There's a lot more, on the remortgages I've done recently, there's a lot more paperwork that you have to have, isn't there? There
is a lot more paperwork, Ranjan. We take care of that as brokers, right? So we try to make it as seamless as possible for our clients. It's a good point. There are lots of added costs that are related to every single mortgage deal, but the key thing is, I explain to my client, is don't just look at the headline rate, look at the fees and charges that are behind that rate as well. So a lot of lenders, especially in the specialist market, now charging a percentage of the fee against the loan amount, which can be quite dear. So I always speak to the client, and I actually give them an option, whereas we add the fee to the loan, we either take it as a pound fee or a percentage fee, and I give the client the differences. So when you're borrowing at a 75% level, fees can get a little higher, especially in the specialist lending space, and they can become more dearer as well.
And of course it's skewed, isn't it? Because some lenders make a fixed charge, like £995 might be their lender's administration fee. And some might charge 1.5% or even 2% sometimes. But if you are buying a property in the southeast, 1.5% on a £500,000 loan is a lot more than a 995 fixed fee.
Yeah, no,
so that must influence your decision.
It does influence the decision, and it can be a costly exercise, as you quite rightly said, in the southeast. But it's good to look at the loan over a 5-year period. So I always give the client the total cost for that 5-year period and take into account all the professional fees, including stamp, valuation and conveyancing.
That's a very good point, because I think very few people actually do that, and they don't look at, they get seduced by the headline rate, but they don't say, well, okay, what are the total costs of borrowing, all the fees, all the interest added together, divide it by the loan term. That's basically what you're paying per month.
Yeah.
Is that what you mean by total cost of borrowing?
Yeah, over the period of time. Yeah, I totally agree with that. That's what I meant. So don't get, all I tell my clients is, well, I have a lot of clients say to me, well, I can get this rate. Well, I'm saying, okay, that's fine, but what's the cost behind it? And what are the true costs behind it? Because everyone will lurch you in with all these headline rates, but does it fit your credit profile? Does it fit your portfolio? Does it fit your liquidity? So it's key to understand the whole metrics behind the rate as well.
Now, the mortgage market is always changing. I mean, I remember the days where 90%, 85% was the norm. Now you need more deposit than before, after the credit crunch of 2009, but it's eased a little bit. Loan to values are inching up a little bit now by some specialist lenders, but it's typically you need 25%. Would you say? Yeah,
typically in the buy-to-let space, 25% is a good space to be in, just simply because you have access to all the lenders in the UK from a 25% deposit standpoint. As you said, the amount of deposit is somewhat being loosened, and there are now lenders that are lending up to 80 and 85% loan to value on buy-to-let properties.
Now, when they offer that 80-85%, what is there in the background in terms of the total cost of borrowing with other fees? What do you lose by being seduced by that higher loan to value?
Yeah, you know what, you at the end of the day, you pay for what you get. So if you're looking for highly leveraged, the lender's you're gonna expect to pay the higher fees, which go in tangent with that. So typically 85%, you're looking at high fours. So 4.5 to near 5% for 85% loan to value. It's not for everyone. Not everyone wants to borrow at those sort of rates compared to rates at 2.5, 3%.
Yes,
so it can eat into the net profit on the buy-to-let deal. But it's all about doing the numbers on day one prior to buying the property or doing the remortgaging. And that's what we do as mortgage brokers. We work with that client, ensuring that it's the right deal for that client and it meets their goals going forward.
What's the optimum level of borrowing, do you think? I mean, yes, you're right. I mean, when people work out the cost of that higher leverage, it may not be worth it. But then at the other end of the spectrum, sometimes I've noticed that you don't get much of a discount or anything from the lender if you say, I want a 50% loan as opposed to a 65% loan. Yeah. There isn't much in it, even though it's much less risky for them. So from that point of view, you sometimes think, well, you might as well borrow a little bit more because they're not giving you anything for borrowing less. Yeah. Is there an optimum level, do you feel, that you should keep your borrowing within to get the best value in terms of total cost?
Yeah, no, I think there is definitely an optimal level. And I think the bracket is probably between 50 and 65% loan to value. Mm-hmm. That's where you're going to get the real prime low rates with a lot of the lenders. But most lenders want more leverage because they want to diversify the portfolio and buy further properties further on. But I have clients that have portfolios and the average loan to value across the book is 50-55%, which is a nice place to be if you can afford to be in that position. What
do you think about, I mean, there's the standard mortgage lenders offer 25, some even 35-year term. Yeah. And some of the sort of specialist banks offer sort of margin products at much less interest rates, but the loan periods are much shorter term, sometimes 5 or 7 year money. Yeah. What's your view on going for a much lower rate but just having a 5-7 year loan term?
I don't think it's a bad thing. You have to understand what's the exit. Mm-hmm. It's key to understand what's the game plan going forward. It's all well and good looking at these headline rates to absorb them for your low cost up front, but you have to have a gain, you have to have an exit on that 7 year deal because 7 years are going to fly by. And the last thing you want to do is when it comes to refinance, you haven't got a home to go to. Yes. So you have to plan ahead, albeit that the market is very liquid. There's lots of lenders out there that want to lend, but it's all about working in tangent with your property goals as well as ensuring that you've got the right lender by your side as well.
Now, one question that I've had from a couple of people is that they're worried about whether, because buy-to-let loans in your personal name are worded, the contracts are worded in a very sort of consumer type way, not that different from normal homes on your, mortgages on your own home. Whereas a lot of business loans are worded quite differently. And there are lots of things where the banks can have instruct revaluations if they feel the covenants are not there and all this sort of stuff. Now, is a limited company buy-to-let loan more like a commercial loan, or is it more like a traditional buy-to-let loan that you'd have in your own name?
I would say it's a lot like the traditional buy-to-let loan in your personal name, and the simplicity is limited company is a wrapper that the property is owned in. Ultimately, you're still a human, you're still the applicant, you're still the director behind the scenes. So that they're willing to lend to a limited company, but at the end of the day, your personal guarantee is still up for grabs as an applicant.
I mean, this is the other question that people have, is that they're buying in a limited company, so people think limited company means limited liability, but that's not the case with mortgages. Is it possible to get a mortgage in a limited company without offering a personal guarantee?
The short answer is no, unfortunately. The lender's doing its utmost to support you through your buying property in a limited company for whatever reason it be, but unfortunately you'll have to always give a personal guarantee in every transaction.
And that is for every shareholder? Do you have to own a certain percentage of shares in the limited company before you're assessed?
That's a good question. So the rule of thumb is anybody with 20% or more shareholding needs to be party to that loan and will be assessed and underwritten by that lender. So 20% is the rule of thumb.
So if it's less than 20%, then that investor in that company will not have to be assessed.
That's correct, yeah.
So a lot of people these days are doing JVs and getting together, they're forming a brand new limited company to buy a property. But some people are saying, well, do I need 3 years accounts? So we've just met up, we want to buy a property together, we set up a new company. The company has just been established this morning. Can we get a loan in that company?
The answer is 100% you can. You just got to remember you've got to have the right SIC code. So one of the SIC codes.
What does that mean?
So that's the something industrial code. Remind me, Ranjan.
I've forgotten what the S stands for.
Yeah, so right. Well, maybe you guys can put it in the comments and
let
us know.
Below. Yeah,
something industrial code or something like that.
But Companies House allocate a code to describe the type of business that every company in the UK does.
That's right.
So what you're saying is that lenders will consider it if the SPV, the special purpose vehicle, the new limited company, has been set up with a certain SIC code.
Right, and one of the SIC codes is 68209 and 68100. So
I was expecting you to rattle those off like that.
It's, because it comes off at least once a week.
What do they mean?
Yeah, so the code's 68209 and 68100 anyway.
Yeah.
So you've got to ensure you have that SIC code at the inception of setting up the SPV. But going back to your question, yes, you can set up an SPV, a limited company, with Companies House at 9 a.m. on Monday morning, and you can go and put an application to the lender in the afternoon after lunch.
Okay, so when you're buying as a JV, so we've met in the pub, we want to sort of set up the new limited company and everything like that. So our individual credit is then, and us as, we need to have clean credit history and the property needs to be a good deal.
Yeah.
Is that basically it?
Yeah, the nutshell is the lenders want to lend to good people that are good for it, credit-worthy, trustworthy people. Having said that, there are, as I said, there's 40 odd buy-to-let lenders in the market. Not every lender needs to have an applicant that is squeaky clean. Now, what I mean by squeaky clean is we might have clients that have missed payments on mobile phones, car payments, lease payments, even a mortgage payment. Now, there are homes, and what I mean by homes is there are lenders out there that will lend to you on that basis. Every lender has their own appetite. So whether you've got 2 defaults within 12 months, 3 defaults within 36 months, there are lenders that will look at your credit profile and lend to you on those bases. Now, as a mortgage broker, that's what we do. So I have quite an open and honest, frank conversation with all my clients to say, remember, I work for the client, I don't work for the lender, so I always tell my client that. So tell me everything, financially what's happened within the last 7 years, and I can work to that, because the last thing I want to do is put an application into a lender and they decline it because of XXX. So for me, it's key that I have an open and honest, frank conversation to understand if there's been any pitfalls in the past, where they are today and where they want to go. So I'll make sure that I know all the pitfalls, I know all the background history, and when I put the application to the lender, there's no reason why it should flag up or get declined.
I mean, 10 years ago, when you went for a limited company loan, most lenders used to ask for business plans, and they wanted to meet you and interview you, and that used to be a bit of a daunting experience and all of that. Do they still want all that these days for limited company buy-to-let?
Yeah, when the PRA changed their rules, a lot of lenders...
What's the PRA?
The Prudential Regulation Authority.
What do they do?
So they're the guys that govern the buy-to-let space. So they are regulators. When they changed the rules and they wanted everyone to have business plans, forecasts and cash flows for limited company transactions and new buy-to-lets, they wanted to apply for that. So what a lot of lenders did was they put it into their criteria that a lot of clients want business plans and so on. But over the last 12 months, a lot of lenders have shied away from that process. They're still following the PRA guidelines. However, they've mitigated that and they've channeled their application into different manners to ensure that they're still meeting their PRA guidelines, but making sure it makes more of a seamless application for the broker and for that client journey as well. But going back to your question, no, you don't need business plans and forecasts. And if you do need them, most lenders only want one pager, and it's quite self-explanatory. And that's what we do. We help our clients, and we help our clients complete those as well on their behalf.
Okay. So are you saying it's a tick box exercise, or it's a bit more involved than that?
Depending on what lender you go to, majority is tick box / a few lines you need to write. But we work with that client and that lender and ensure we do the right thing by the client and the lender as well.
So, I mean, a lot of people have been very worried about this 6 month. Not worried about it. I mean, they find it a pain in the neck, quite frankly. First of all, can you just explain what is the 6 month rule?
All right. So the 6 month rule came about because, I don't know if you guys remember, but I'm sure your viewers will know, back in the 90s when we had a big property boom, there were a few fraudsters out there that used to do back-to-back transactions. And what they used to do was they used to manipulate, create, buy and sell property, but nothing would ever exchange hands. So they will swindle millions from banks. So that's how the 6 month rule came about. So building societies put in a rule, the 6 month rule, so that you can't remortgage within 6 months.
Oh, I see.
Because of the boom and the fraudsters. So that's how it came about. So it's in the 90s, building societies brought that into play.
So as a result, if I buy a property today, I have to wait 6 months before I can refinance it?
No, you don't. So the reason why I say you don't is there are lenders out there that will allow you to remortgage within 6 months. Now, there are some caveats to that. So if you bought something at auction, say for example, for cash on the 1st of August, and you wanted to refinance on the 1st of September, most lenders will remortgage at the same level of purchase price.
Yes.
However, that's not going to be good to you as an investor.
No.
So what lenders will do is, if you bought something for 100,000 at auction, you've spent, and you've got it at 50% below market value, you spent 10,000 to upgrade the kitchen, the bathroom, a bit of painting and so on. Your capital you've put into it is 10,000, so it's taken to your investment to 110. But the true market value is 200 for that property. What the lenders will do is, within 6 months, most lenders will only do pound for pound at the purchase price. The second tier of lenders will give you 100% of your purchase price plus 100% of the cost that you've put into the property, but not the 100% of the market value.
Oh,
however, if you bring a property up to its true standard that meets all the requirements, say for example it didn't have a bathroom, it didn't have a kitchen, it was uninhabitable, unmortgageable and so on, but you brought it up to such a level that it meets and exceeds all the properties on your street, you have an argument to have with the lender. So there are a couple of lenders out there that may, depending on valuer's comments, will remortgage it at the true market value, even though you bought it at a discount and within 6 months. So worst case is you'll get 100% of your cost of refurb, including professional fees. Best case is you'll refinance at the true market value within 6 months.
But what I say to people is, how important is the 6 month rule in this day and age? Because bridging finance is so readily available and so cheap. It's less than half the cost it was 10 years ago.
Right.
So what is the big deal about buying a property with a bridge, paying it off in the 6 months, and then refinancing it with a long-term buy-to-let lender, and then you'll get the maximum value?
Yeah, no, I totally agree. So what lenders are now doing is they've created bespoke products just for buying properties at auction via a bridge. So one lender in particular, it's Precise, they offer a bridging product where you buy the property under a bridge and they'll set 2 applications at the same time. So they'll give you a value based on your bridge and lending at up to 75%. And they'll also give you an application at the same time and do a buy-to-let mortgage up to 80% of the post-works valuation. Or the lender like Precise will allow you to refinance with them, if you take the bridge out with them, after 1 month at the true market value post-works.
Oh wow.
Yeah.
Okay. What are the costs involved with that? Because presumably surveyors or people will have to be involved in assessing those works and values.
Yeah, valuation fees, legal fees, and all the other professional fees go with it. They are all readily available on their online website, and I can help with that, with information. It depends on property values.
Do you find that in cheaper value areas, it's probably not worth all the cost to do it that way?
It just depends on the numbers at the end of the day.
Yeah,
it can be feasible. There's no reason why it can't be. But you've got to do your due diligence on day one. So you're buying it for X, and tomorrow it's going to be worth X. So you've got to ensure that you take into account all the fees, including all the professional fees, because it can mount up.
But even with bridging finance, is that let's say, because in these days there's so many motivated sellers out there, the property might be worth 100 grand, but a motivated seller needs to move quickly and will sell it to you for 75.
Right.
And these are real situations, but the bridging valuer will not lend you based on the 100 value. They'll lend you on the purchase. Is that right?
That's right. So it's the lower of the purchase price or the valuer's comments. So it's the lower of that, unfortunately.
It's the lower of those, and there's no bridging company out there that would circumvent that.
Well, I wouldn't say there's not, but if you go to a local family office or private individuals, they may lend to you on the true market value rather than the purchase price.
This is the value of having private investors, I guess.
Yes, if you've got the high net worth friends, yeah, for
and
sure.
if you do that, then I mean, typically when I work with private investors, and we actually do this in our own business, where we will lend to people who are in this situation, and we'll lend on value, but we will usually buy it in our company name, so we have the
security.
First legal charge and all of that, and then it's all secure and that kind of thing. But there are plenty of ways to skin this cat, because what people want to do, what people are trying to achieve as a property investor, is a fast velocity of your own cash. In other words, cycling through your own cash as fast as possible.
Yeah.
And I get from what you're saying is the way to do that is pretty much bridge and then refinance after 6 months.
Yeah.
But then you are using the minimum of your cash.
I agree. Well, bridging is great because, as you said, Ranjan, the rates are plummeted in a favourable way for the client. Just to give you an idea, sub 50% loan to value, looking at 0.49 per month, which is
crazy.
It's in comparison to term loans, a majority of the cases. And even if you're looking to borrow at the top end at 75% loan to value, there's many bridging lenders out there that will lend to you at 0.75, 0.85, which is not bad because of speed and flexibility with a bridging loan compared to a traditional mortgage loan where it can take 8, 10, 12 weeks to do the deal, whereas bridging can be closed and wrapped up in 3 weeks or less than.
Now, a lot of people have asked questions about auctions, because there's some great deals in auctions now. And particularly when the hammer goes down, you've got 28 days to complete. Is it possible to get a buy-to-let loan wrapped up in that 28-day period?
The short answer is probably not. And the reason why I say that, it's the whole process. So as a mortgage broker, we can get a decision in principle within half an hour. And then we can move on to full application, which will take another half an hour or so, give or take. But then it's the application to valuation can take a day, it could take 3 days, it could take 7 days. And we're in the month of August now, where it's summer holidays, staff go away, and the queues start building with applications. So it's very difficult to complete a buy-to-let within 4 weeks, but I'm sure it can be done. I'm sure it can be done.
Okay, so if you want to sleep at night, then...
Yeah, I would go down the bridging route for sure, especially for an auction purchase.
Because I think what I've tried to do in the past is get it done.
Yeah.
Try to get it done. Because there are lots of things you can do, like get the decision in principle before you go to the auction.
Yeah.
And then get the solicitor booked and ready to... He's already looked at the legal pack and all of that. And you give it a go, but always do so having a backstop of a bridge or cash to complete.
No, I agree.
And then if you manage to get it done in 28 days, great.
Yeah.
If not, you've got a plan B.
Yeah, there's nothing wrong with that. And mortgage is always going to be the cheapest solution. There's no two ways about that. But yeah, as you said, you rightly said, ask your solicitors to put in the searches to the local councils once the hammer drops. because that's really the time that it takes up with the searches.
Because of course, if you can sew up a mortgage in the 28 days, you haven't got the 6-month rule to worry about.
No, you don't.
Buy and refinance and all of that. So that can be beneficial. Now, a lot of properties at auction again are tenanted. Are there any problems in buying a buy-to-let property with a tenant in situ?
It's a good question. It doesn't come up too often, but when it does, the short answer is it's part of the legalities that your solicitor will do, part of the conveyancing. Now, part of our application at a buy-to-let stage application, it does, one of the questions are, most applications is there a tenant there in situ at the moment? And a lot of lenders don't want a tenant in there at part of exchange and complete for their own reasons. But I would always suggest if you're buying something at auction, I would ensure that you've done your due diligence, and one, if there is a tenant in place, is there an ASD in place? When does the ASD expire? Or have they served notice?
Yes.
So it's keen to understand who the tenant is, because once you've exchanged and completed, and that tenant's your responsibility, and it might be your burden to either remove them or whether to keep them or not. So I would say make sure you do your due diligence and speak to the solicitors, and make sure your solicitors have that two-way conversation.
And of course, if the previous owner hasn't served all the papers, like when you start a tenancy, you've got to do all the gas safety certs, you have to give the right to rent booklet and all this. If they can't prove they've started the tenancy properly, then the new owner will not be able to exercise Section 21, which
Very
can
true.
be a huge risk.
Very true.
Okay, so what about a lot of people are chasing high yields, and you do get high yields from, say, flats above shops. And a lot of people now have converted commercial properties into residential use. Are there any particular problems with getting buy-to-let loans on those sort of properties?
No, definitely not. There's a full range of products out there to service mixed-use properties, so residential above commercial. There's no issues whatsoever. The only caveat I would say is if the residential is next to, for example, pubs and clubs, that sort of thing, lenders sort of shy away from that, but just simply because of a resale perspective, the lender need to pull the plug.
This hasn't come in from one of the viewers. This is my question. What is it lenders have against fried chicken shops? What?
I have no clue. It just makes it easier to go downstairs and pick some food up. But no, all I would say is, I guess it's the late opening hours, the noise, people eating their fried chicken out on the street outside your door window, and it's the reputation that goes with it, I guess. So just be thoughtful if you are looking to buy a flat above a commercial property. Just ensure that it's got the right shops either side of that apartment. Just simply because. You want
now
to
that's an interesting point, actually. It's not just the shop directly below the flat, it's the ones next door.
100%, yeah. So I would, my rule of thumb is look within 100 yards left and right and see what the commercial tenants look like, and then take a view on it. But having said that, there are lenders still out there that will lend on that basis, but they'll just load the rate accordingly.
I mean, the other interesting one that they don't like is dry cleaners. Any idea? Is it
Really?
Yeah,
That's a new one for me.
They moan about. I found out we bought something above a building that included a dry cleaners, and they moaned about it because apparently it's to do with the chemicals and all of that. But we got it through because this dry cleaner doesn't do any of the dry cleaning on site. They have it picked up and done somewhere else.
Yeah.
And the valuer went back to assess that, and because he declared that to be the case,
it made sense for the lender.
Then they allowed it.
Yeah, no, going back to that point, it's actually a good point. So I have a lot of two-way conversation with a lot of lenders, and the reason why I say that is I have BDMs, business development managers, of lenders calling me every other day. Can we come in? Can we see this? Want to go through the product? And I always tell them, yeah, more than welcome to come in, because I'm educating myself and I'm ultimately doing the best for my client. But what we do is, as mortgage brokers, we speak to that lender and talk them through the deal. So I always ask the lender and be cheeky, can I speak to the underwriter? Because ultimately that underwriter is the one that's going to sign the deal off. So for me, I speak to the underwriter and talk them through the deal. Because on paper it might look like one thing. When I talk to a human to human, it might mean something totally different. So that's where I go over and beyond for our clients, and ensuring that there's a reason why this deal fits with yourselves, but I need to talk to you through the whole deal. So it's important that you use a mortgage broker that understands your deal, ultimately can speak to that underwriter and talk them through that deal and get the deal over the line. Because if you didn't have that conversation re your dry cleaning, they would have thrown that deal out the window.
Yes,
so
yes,
that would have wasted time, cost, money, and so on. So you did good there.
And I think when you
Should
get
become a mortgage broker.
when you get the sort of unusual properties, those sort of conversations are absolutely essential.
Yeah.
The more you stray away from vanilla, the more profit you will make in property.
Oh, 100%.
And the more bespoke your financing solution needs to be.
I totally agree. And the way the market's going anyway, it's becoming, the market is moving more and more in the specialist arena. There's no two ways about that. And lenders are cottoning on to that all day long. They're transforming their criteria, their product guides every other day, which is a good thing for you and us.
Of course, having to rethink. I mean, the other area people are looking at more and more is multi-unit freeholds.
Yeah.
So you might have 2-3 flats in one building, and you're buying the whole freehold. A few years ago, they would worry about exposure in a particular building. Is that so much of an issue now if I want to buy the whole building and it comprises of 4 flats?
No, there's no issue whatsoever. Lenders have a exposure level. Usually it's 4 to 6 units within the block. So as a broker, that's what we do. We ensure we go to the right lender, ensure we know exactly how many titles there are, whether it's one title on the freehold or there's 4 separate leases. So we'll understand that from the client's perspective and then talk to the right lender and through the deal. But yeah, no issue whatsoever. Usually 4 to 6 units within a freehold.
Is it better to, because a lot of people talk about, title splitting as the route to instant riches and all of this sort of stuff. If you've got a building which is 4 flats, is it better, do you feel, from a mortgage perspective, to remortgage the thing as one freehold title comprising 4 flats, or split them up into 4 leases and remortgage them individually?
4 leases is always going to be the best investment, and that's where you're going to get the true value and the higher level of valuation, that's for sure.
Why do you think that is?
You know what, it's a good question, because as a lender, I'd prefer to take on borrowing on the whole freehold, to be honest with you. But I think from a resale point of view, they can sell one flat at a time immediately, rather than selling the whole block to one investor. So I think it's more from a timing perspective that it's better to have 4 separate leases.
Yes. No, I agree with you. I think what I've tended to do is blend it, actually. So if you get if you have 4 flats in a building, you get 4 leases on each one, but you remortgage all the 4 leases and the freehold to the same lender.
Right.
And you negotiate a good deal because they get the benefit of having great security because of the disposability of the individual leases.
That's it.
But the bulk element of having one large
I totally agree.
composite loan, so you kind of blend it.
Yeah, no, it's true. No, it makes total sense. Go to one lender, and you're saving fees and costs as well
Yes.
by doing it one lender, one mortgage as well.
Absolutely. And there's another thing that goes around, is doing the round about commercial valuations, that you can somehow get. You can escape a bricks and mortar valuation on a residential property. Let's say you've got a 10-bedroom HMO, and get it valued up based on the income that's producing. Does that work?
It doesn't, especially in London and the southeast, simply because the yields are quite
low.
flat, are low. The only thing I would say is if you're going to convert a property into a HMO and go the full Monty in terms of 10, 12 rooms, all the fire, health and safety, all the doors are on and so on, you may get a commercial valuation. However, if the estate agent is unable to put that property back on the market as a family home, then you probably will get a HMO yield valuation.
By being in an Article 4 area, what you actually mean is that no one else could come along and put up an HMO without getting planning. So that restricts supply.
Right.
Which means that there is an investment value to that asset in an Article 4 area. Is that what you're saying?
Yeah, I am saying that too. But you have to remember, to get the HMO valuation, the commercial valuation, it has to fit the bill. So it has to stand out from the crowd, and it has to be demand for that property.
Oh, I see.
So if the yields are 10, 12% as a HMO, which is great, but you have to ensure that you choose the right lender that's going to go out and do the HMO valuation, and the value that goes out will give you a bricks and mortar valuation and ensure that there is demand for that type of property in that area too.
So when you get a valuation booked, do you advise people to go down on the day of the valuation and meet the valuer?
I would recommend them going to see the valuer, and the reason why I say that is because you know that property better than that valuer does. So you're the owner of the property, you know the layout, you know the benefits, you know all the advantages that property holds. So I'd probably suggest, yes, go there. And you may also want to take a list of comparables. So comparable sold prices within the last 12 months, comparable properties that are on the market today, and comparables of rental properties in the market as well. So within half a mile and within the last 12 months.
Absolutely. And now the thing is, the surveyors will have access to all these comparables on their database. But that's not the point. It's to present yourself as an entrepreneur, as a business person. I mean, that's not the day to wear your hoodie and all of that sort of stuff. You know, look presentable, look like a business entrepreneur, and demonstrate that you know your business. So it's not about saying you don't have the comparables, I'm offering them to you. You know your comparables, and you are a credible business person who knows what they're doing. And you can also, it doesn't do any harm to chat a little bit about what you plan to do with the property, because that gives away some of your whether you have business acumen and whatnot, and these soft things do play a part.
Yeah, no, I totally agree, Ranjanis. You're totally right. It's all about helping the valuer do his job, but again, not doing his job for him, but making sure that he understands that you're in it for the long term, you're in it to do the right thing, and ultimately make money along the way as well.
And of course, sometimes, of course, because you've made that contact, it may be easier to get things changed, because sometimes the valuer makes a genuine mistake and they produce this report, and they've said something wrong in there. What advice do you give to people who need to get a valuation report changed in some way because it's scuppered their deal?
It does happen. That is the honest answer. It does happen. We do get downgraded on vals. What do we do? Well, the first thing I do is actually speak to that lender and talk them. Sorry, let me take that back. What I do is I actually read the valuation report myself. So I make sure if the house has got 4 bedrooms, I make sure he's seen 4 bedrooms and all the other bits and pieces that go with that property. So I make sure that the property stands up to what we've put on the applicant and what the client's told me, to what the values compared it as. So I'll read through the whole report, make sure everything makes sense and it is what we've put on the application. Then I'll speak to the client to give them the unfortunate news. However, we will then challenge that valuation report. And what I mean by challenge is we'll go back to the lender to say why we're challenging it and the reason why we're doing it and why we feel it. So that's going to be doing our own research, the client and my research, to say, well, his property's up the road, around the corner, that are valued at this, and they've just sold for this. Why is my property being reduced by 10% and so on? So we'll speak to that lender and talk them through the property and our comparables. And most lenders have a appeals decision template which we can complete, and then it will go up the appeals channel to challenge the valuation.
Is it easy? Because once it's put, pen to paper or finger to iPad these days.
Well, I'm actually doing one with Paragon as we speak. I'm challenging a valuation with Paragon because they downgraded it by about 35,000, which is scuppering the deal, unfortunately. So we've put a challenge in which is open and honest, and it does make sense on paper, and there's comparables to back it up. So hopefully we win.
So we're shooting this coming up to the autumn of 2019. What do you feel the mood is among valuers? Because sometimes they're not that bullish on the market and they are looking to down value a little bit to factor in concerns they have for the year ahead. Do you feel there's that sort of mood in the valuations at the moment?
Yes, I'd probably say around 10 to 20% of the valuations are somewhat downgraded. Whether that's something to do with the big B, I'm not sure. Whether it's a valuer's not doing enough research, and with the news that's going on with the economy, housing pricing and so on, they feel that they need to downgrade the properties. I'm not sure, to be honest with you, but there is a little trend of downgrading valuations, which is not helping the deal, especially if the clients are looking to borrow the ultimate maximum.
And this is the reason why you really need to focus on the below market value opportunity, because if you feel the market value is 100, you've got to be buying it at 80, because the lender will lend on loan to purchase, and you're more likely to get a valuation supporting you at 80 than you are
100.
if you were buying it at 100.
Yeah, no, I totally agree. So it goes back to ensuring that you do the right thing. So do the due diligence on that property. So try to get something below market value, because just in case, as you said, you get a scuppered valuation report, or we have a housing crisis, we get property prices plummet, at least you know you're in safe haven because you picked it up at 20% below market value.
Yes, and it's all about buying at enough below market value to shield you against potential downside over the immediate term. That's what it's all about,
Yeah,
isn't it?
totally agree.
So we've got Brexit coming up. Who knows what's going to happen to interest rates? I mean, we're already at quite a low level. What do you reckon?
I think we're going to have a 25 basis point reduction. I think probably in November or December. I'm hoping so.
Why?
Anyway.
That's a very bold prediction.
Why do I say that? I think the Fed reduced their rates last month.
We always follow them.
And we do follow them. So I think Bank of England, I think Mr. Carney's got no option but to reduce them. But I think it's actually good for the market. We need to stimulate the market, and the best way of doing it is reducing those rates. I know the savers out there are not going to be happy with that, but what's the difference between 0.5% and 0.75 in the bank account anyway? It's not very much anyway. But I would say we are going through a transition at the moment, whether it's a housing crisis, it's Brexit and the mortgage market. But I'm optimistic, and I have to be. And I think lenders are as well. And it shows with the products that they're putting out, the amount of liquidity, the willingness that they're looking to lend to the clients. And just general, what I'm observing from the market, it's a positive market for sure.
What about SDLT stamp duty? Because I mean, that's the pig's ear. One day, it's already too high as it is. I mean, there's a 3% surcharge on it. I've got a video on how to avoid 3 ways to avoid SDLT. I'll put a link up on the card above. But there's 3% surcharge, which has scuppered many propositions in the southeast. We got the new Chancellor talking about shifting that burden onto the seller, and now he's backtracked from that. What do you feel about SDLT? Is it at the right level? Do you think it's going to come down?
I think, I'd love them to remove the surcharge, the additional 3% for second and third home buyers and so on. I'd love them to reduce that, and I actually think they need to increase the stamp duty for. At the moment, it's 300,000 for 0% up to 300,000. I think if Mr. Khan increased that to 500,000, I think that'll stimulate the market or breathe a bit more confidence into the market.
I think it's Javed, isn't it?
Oh, sorry, Javed. Yeah, sorry.
You're thinking about the mayor.
I'm thinking of the mayor. It's his cousin.
Unfortunately, he's not that powerful.
No.
It's Mr. Mayor.
It's the Chancellor, sorry, yeah, not the mayor.
Okay, so listen, thanks very much. How can people get in touch with you? What's your website?
The website's ourmortgagebroker.co.uk, or you can reach the office on 0203 971 1234.
So we'll put some links in the description. Please comment, like us. It helps us on YouTube. We'll be doing some more Q&As with experts. Tell us the kind of professionals that you want to see interviewed for one of these Q&As. Just tell us in the comments below. We put out new videos every week, so subscribe and press the bell icon so we notify you, and see you guys in the next video. Happy investing, and thank you, Akhil.
Pleasure, thank you.
If you enjoyed this video, hit the like button. If you're not a subscriber, what are you waiting for? Subscribe, hit the bell icon. As soon as we upload, we'll let you know. And enjoy these. They're all dedicated to helping you be more successful in property. Happy investing.